the campus of Yale University, this is Business Talk with Jim Campbell, nationally syndicated across the country on the Biz Talk Radio Network and coming to you from our flagship stations, Yale Radio WYBC and 1490 AM WGCH Greenwich. All talk and all business, 60 minutes of radio with leading figures from the world of business along with the business of politics and sports. A call for Wall Street to get its hands out of client pockets and return financial services to serving client interests first, not Wall Street's. We're taking on Wall Street today on Business Talk with Jim Campbell. John Kay is a visiting professor of economics at the London School of Economics and a fellow of St. John's College at Oxford. He's director of several public companies and contributes a weekly column to the Financial Times, author of 9 books, and the latest is Other People's Money, The Real Business of Finance. Calling in from the south of France, how are you, Professor?
I'm very good, Jim. How are you?
Well, this is quite a book. It's kind of a radical manifesto, an indictment of the financial services business, the City of London, Wall Street, etc. And you make the case that actually less than 10% of the business and transactions they do is related to what would be called Main Street's client interests. How did Wall Street end up so divorced from Main Street?
What has happened over the last 30, 40 years is we've had a world in which the financial sector has come more and more to deal with itself and less with external clients. So if you were to go around the City of London or Wall Street today and ask what people in these office blocks are doing, the answer is, to an extent that almost defies imagination, what they're doing is trading with each other. And it's that growth of trading within the sector rather than serving ultimate needs of savers on the one hand and the people who want to use savings for business investment and house purchase and so on the other, that has created the issues and many of the problems.
All right, you call this the financialization of Wall Street and sort of a move to trading environment, and this may not make Jamie Dimon very happy, the CEO at J.P. Morgan, but you really talk about the impact of the financial sectors not being positive. You talk about the outputs poorly reflected in economic statistics, minimal contribution to quality of lives, minimal advancement of social and economic societal goals. What do you mean by all that, and are those appropriate to be attached as metrics to the finance sector?
Well, let's be careful about all this because we do need finance. And, we don't have effective modern economies without a financial sector. But if you ask what we need finance to do, we need it to run a payment system. It's basically that utility, which is the core of finance, to enable us to pay our bills, receive our wages and salaries, to enable businesses to transact with each other. That's the core business of finance. And it's actually what most people who work in the finance sector do. Someone who is a banker is typically not someone working on Wall Street earning a telephone number salary. It's a rather mundane officer working in a bank branch somewhere outside New York or the City of London. So we need finance to operate that core utility. We need finance also to enable us to manage our wealth over our lifetimes and perhaps between generations, because we have to finance education when we're young, we have to save and provide for retirement when we're old, and if we're to make the sums add up, we have to do some saving in between in order to compensate for that. And we also need finance to fund business investment, to take savings and transform them into investment. We need capital allocation. And finance can also help us mitigate the kind of risks of everyday life. But what I believe is that we need a finance sector that focuses on these core functions of serving users of the finance sector instead of, as I've described, doing so much trading within the sector, people trading with each other.
All right. So you feel that this sort of excessive trading and financialization causes the financial sector to sort of go from excess to excess, crisis to crisis, a lot of underlying rationale for the 2008 crash?
That's right. And the proximate cause of the 2008 crash was essentially what happened in the U.S. mortgage market, And that began in the 1980s with securitization of mortgages. Now, in the old days, you went into a thrift to take out a home loan. That thrift was a rather boring institution which collected savings from the local community, and you had to persuade a rather reluctant manager to make a loan to you. And typically the people who made the loan would stick with that loan for the life of the mortgage. What happened in the 1980s was a man called Lou Ranieri at Solomon Brothers famously said, mortgages are math. And that meant you could take a package of mortgages, you could translate it into, you could turn that into a security, that was a package of mortgages, and you could sell that security on to somebody else. Somebody who might not know very much about, might know anything, in fact, about the underlying borrowing, the underlying house, the underlying capability of the borrowers to service it. And that activity got completely out of hand, with the result that by the early years of this century, people were desperate to find mortgages that they could package up in this way and cared less and less what the underlying quality of these mortgages was. And that's the immediate cause of the 2008 crisis, a blow-up in that particular kind of security.
Let me ask you, are you calling then for either a reduction or termination of securitization? Obviously, one of the benefits is it increases the supply of mortgage financing that banks can offer by packaging and getting them off their balance sheets. Where are you standing on that?
Well, it's not clear it does actually increase the supply. In the end, it's household savings that have to go into people's house purchases and into business investment. And the total of these has simply got to add up. What securitization was not actually a means of finding new finance that hadn't been there before. It was actually a means of redirecting the old channels of forms and packaging them in new forms. And that's what I try to do in the book, and what I think people find difficult to understand, that actually in the end, household savings, the savings of the nation have to match the assets of the nation. And that's just basic accounting.
All right, let me ask you a couple of other issues that were behind the crash of '08, which is, first one is liquidity, obviously. Lehman Brothers, Bear Stearns, or even Drexel in the 80s. When the short-term financing market, the repo market, freezes, these firms can even be profitable, but they go out of business overnight with liquidity. Is this a fundamental problem of lack of capital in the industry, or why are they set up so that they're so risky, so they can actually shut themselves down overnight almost?
Well, this goes back to the fact that the business of Wall Street is mainly trading with itself. So why do repos come into existence? Why did securitization come into existence? It is all this trading within the sector itself. If you go back to this basic identity that says what is happening is household saving is being translated into business investment and household borrowing. Household savers don't actually need that much liquidity. The people who need the liquidity, and the people who ran out of liquidity in 2008 were actually institutions trading in these intermediary markets. It wasn't because you and I suddenly decided we wanted to take our savings out and spend them. It was actually because the intermediation market gummed up, because people discovered how badly the people who were in that intermediary market, like Lehman, had been screwing up their business.
Another big issue is the conflict of interest that ended up getting built into these institutions who were doing so many sides of everything. The Abacus deal at Goldman is always a good example. You raise it too, where Goldman ends up betting against the interest of its own clients that it was selling its own merchandise to. Talk about the conflicts of interest issue.
Well, the conflict of interest there was that the Abacus transaction was one in which a hedge fund manager, John Poulsen, selected a group of subprime mortgages that were pretty likely to fail. He got Goldman to devise some packaged securities round about these, and Goldman then sell them to your clients. And there's a famous exchange between Senator Levin, Senator Collins, and some of Goldman Sachs executive in the Senate Investigative Committee, in which they ask who was Goldman actually acting on behalf of in these transactions. Was it Paulson? Was it the Goldman customers who were being sold these securities? Or was it in reality Goldman itself?
Talk with Jim Campbell over the Biz Talk Radio Network. That's 350 stations around the country. You can go to biztalkradio.com, find the station nearest to you, listen over the internet, and access our archive of podcasts. We'll talk about the real business of finance when we get back. And we're talking with financial industry reformer Professor John Kay, he of LSE and Oxford. We've been talking about the causes of the '08 crash. Let's focus on the retail part of the business now. You talk about this chain of intermediation, or what I call kind of an assembly line that picks the pockets on retail transactions, mutual funds or trading shares or whatever, all these pieces that are sort of pulling off fees. Talk about that and the impact on the retail investor.
Well, the trouble with the length and complexity of the intermediation chain, which we've now described, there are two problems. One is that the incentives of people in that chain may differ from the interests of the underlying savers or the companies in which money is being invested on the other. But the second is that the total costs of all these people taking bites out of the cherry, pieces of the cake, however you call it, adds up to a great deal. It's quite easy for it to be the case that these costs of intermediation are going to add up to 3 or 4% per year of the value of your investment. Now, think of where we are at the moment. We have interest rates that are barely above zero in the United States and Europe. Even if you add a risk premium for equity-type investment on top of that, you might start hoping to earn 3, 4, 5%. If you're paying 3 or 4% in intermediation costs, almost all of that is going not to enhance your savings, but for the costs of intermediation. And where we are at the moment, where the costs of intermediation having risen and interest rates having fallen to the degree we have, it's actually making long-term saving for retirement very difficult indeed, probably impossible for many people in their 20s and 30s now.
It's all good points because very few individuals understand what's going on along that chain. Back to trading for a second. I want to get your opinion. Now, you have some amazing stats in here. Forward exchange, the daily trading is 100 times the value of the trading in goods and services. Derivatives trading growth is unbelievable, and 3 times the value of the underlying physical assets. I think J.P. Morgan has $77 trillion of gross derivatives. Where do you come down on basically on derivatives trading?
Well, the thing is, as with so much in the financial sector, with what starts off as a good idea, which is taken to wild excess. There is a role for futures and options and swaps and the kind of derivative instruments which were created. But that role is actually enabling individuals and companies to hedge their risks better, to protect themselves against currency fluctuations or against interest rates going up in the future or whatever. And that's how people began to use derivatives. But it's this process of financialization which I've been talking about, by which people ended up trading with each other. So the normal derivatives trade today is not actually someone in the real economy, a business or a household, trying to hedge a position and reduce risks. It's basically people in the financial sector gambling against each other. You think interest rates are going to go up. I think they're going to go down. One of us will be right. One of us will be wrong. We make a derivatives trade that means that depending on who's right, one of us gains at the expense of the other. Now, the value that adds to the economy as a whole is pretty much the same as the value added by any other form of gambling. One big difference is that people who go to Las Vegas or whatever are actually doing with it with their own money. That's not in the main true in the finance sector.
Interesting. Well, a thing that you had in here that interested me in particular is this, that you say the profit for the financial services sector is overstated, and that the return on equity, the basic metric, is a very poor one. Talk about that.
Yeah, there are two things going on here. One is that quite a lot of what is happening is that people think they're making profits because they're in effect borrowing money from the future. That was in effect one of the things that happened in the run-up to the 2008 crisis. Banks were selling overvalued securities, claiming they were making profits by trading them against each other, and then in 2008 they discovered, as in the Abacus transaction we've been talking about earlier, that these securities weren't worth anything like the figures they were in the books at. In fact, they weren't worth anything much at all. So if you were to caricature what happened 2003, 2008, it's to say that banks announced they'd made large profits, paid out a fair fraction, some of them to their shareholders, a large proportion to the people who worked in these banks. Then in 2008 announced it had all been a mistake and they hadn't made loads of money after all. And by that time, it's the shareholders and the taxpayer who actually had to make up the shortfall.
Now, the share of GDP that the financial services business had been increasing rather dramatically, are you calling for the share of the financial output in the total economy to go down? Are you calling for the share of the best and brightest talent that go to Wall Street to go down?
I am. I'm arguing for both of these things. I think if we had a finance sector that focused on what I've described as the real business of finance, functions we talked about earlier, a payment system, risk management, capital allocation, and wealth management, we'd actually have a much smaller financial sector and one more directly related to the real needs of users. And also, it wouldn't be a sector that I actually had jobs for the number of rather talented people at the moment. In my career teaching at Oxford, I've watched things go from a time when a job in the city was something that was taken only by not very clever undergraduates who were well socially connected, to a world in which people were spending a lot more time lobbying for internships with financial institutions than they were in the library. And I don't think that's all in all a change for the better. I often wonder what the opportunity cost of this has all been and what some of these former students of mine might have been doing if they hadn't gone into the finance sector.
All right, we got about a minute and a half to go. Another interesting thing that you talk about is one would think that we need more regulation based on what you're saying, the excesses. You talk about needing less intrusive regulation. What do you mean by that?
Well, I think regulation has been part of the problem rather than the solution. We were talking earlier about securitization. We were talking earlier about repos. The ways in which a lot of these complex instruments came into being is what we call regulatory arbitrage. That is, you dress up some transaction so it gets a more favorable regulatory treatment in its new form than it did in its old form. And that's one of the sources of the complexity which we observe all around the financial system. And I've described earlier how the finance system has always this inclination to take things to excess. And there were good arguments in some cases for these kinds of instruments to begin with, but again, not on the scale in which the markets in them subsequently developed.
You're listening to Business Talk with Jim Campbell. We're taking on Wall Street in Washington from the Radical Center. And coming next, we'll talk about the specific steps to reform the business of finance with Professor John Kay. Now we're talking with John Kay. He's the author of a new book, Other People's Money, The Real Business of Finance. And I always say that people behave how they're paid. And I think one of the most insightful parts of your book We started just ending the last segment on the failure of intrusive regulation. You're talking for fundamental change in culture, structure, and incentives. Tell us what you mean.
Yes, I think we should stop writing very detailed rules trying to govern people's behavior in the finance sector. We were talking just before the break about the way in which regulation has become more and more extensive. We've had what I call regulatory arbitrage. People then devise more complicated rules to try to stop that. People then devise still more complicated instruments in order to get round it. And that's a game that just goes on forever and gets us to where we are today, which is we have rule books that run to thousands of pages and don't actually work very well. Now, one of the things that frustrates me when I talk to audiences outside finance about this is everyone in the audience wants to say what we need to do is regulate this industry more. And I don't think that's right. As I say, I think regulation has been part of the problem. So what I want to do is to focus on the structure of the industry and the incentives of both firms and individuals within it. Structural reform means actually separating out the different functions of the finance sector into separate institutions. One of the things that went with financialization was the growth of financial conglomerates, the JP Morgans of the world, who are engaged in every aspect of the financial sector. Now, the first thing I would like to do then in terms of industry structure is to have, in effect, a new Glass-Steagall for the 21st century. That is to go back to a world in which retail banking was separate from investment banking. And you have the rather boring banks that operate the payment system and make home loans and provide consumer credit and take our savings in order to do that. And that's, as we talked earlier, that's in large part the core business of finance, operating the payment system. It doesn't require very sophisticated people to do it. It isn't a terribly complicated business to run, and it's one which, part of what caused the 2008 financial crisis, was these things were all bound up together because the institutions that ran the payment system or played a central role in the payment system, like JP Morgan and Citigroup, were actually the institutions which were involved in these complex transactions in financial markets. So that's step one, ring-fencing retail banking. And that means that governments or its agencies can guarantee our deposits in the way they do and be confident that relatively secure assets, government bonds, high-quality mortgages and the like, are there to provide collateral for it. But I'd like to go further than that. And I'd like to say that we need to break up investment banks as well. If we ask what the modern investment bank, whether it's the investment bank within JP Morgan or a pure investment bank like Goldman actually does, if you list the functions, they engage in corporate advice, they engage in securities issuance, they make markets in these securities, they trade in these markets on their own account, and they provide asset management services to people outside the financial sector. Now, all I have to do, I think, is list these functions, and you can see how every one of them potentially comes into conflict with every other. So what I would like to see would be a world in which asset management was separate from market making and securities trading, was separate in turn from securities issuance, and that was separate in turn from corporate advice. So these conflicts of interest went, and the complexity of the structure was also reduced. And what we also need to do is try and free these institutions of the kind of conflicts of culture that have been endemic in them since these financial conglomerates were created. Because the truth is, the culture of retail banking, which requires you to process millions of transactions very accurately every day, that's a business that needs to be done in a hierarchical, bureaucratic kind of structure. It's very different from the sort of buccaneering aspect of investment banking.
In trying to reduce the trading, you talk about starving the beast. You talk about rewarding idleness, which is really fascinating because Wall Street is completely driven on urgency and transactions. How would you starve the beast?
There are, I think, two parts to that. One is taking government out of this sector as far as we can. That follows from saying that there's been too much regulation, not too little. We have all this complication of lender of last resort. We have elaborate monetary policies in which everyone is obsessed by what the Fed is going to decide next week or next month. I'd like us to treat finance much more like any other business. And the way we judge any other business is we say, what do its customers want? How well is that industry delivering what its customers want? I just have to say that for everyone to realize these are not the questions where normally they're asking about the financial sector. Now, I think government has to guarantee our deposits, the kind of everyday savings that you and I put into finance. But I think much of the rest of it, government should leave alone. And that means if government is to backstop our deposits, that's another argument for why we want to separate the business of taking deposits from the business of trading in financial markets. If, as I've described, most of that trading is very gambling, people taking opposite views about what is going to happen, then one of the key things about gambling is people ought to gamble only with their own money. And in most of the world, we try pretty hard, most other sectors, we try to make pretty sure that that's what happens. We should do that in finance too.
Now, we're going to move into risk management, because I think you had some brilliant insights. And obviously the '08 crash was a systemic crash, the complexity and the interconnectivity. As you said, Lehman wasn't a big player, but it was so intricately interconnected through the CDOs, credit default swaps. And you say if we look at it as an engineering function, there'd be redundancy and modularity built in. Talk about how you would change systemic risk.
That's an interesting story because very few people have thought about saying, how do we deal with complex systems elsewhere? And people of most experience of dealing with complex systems are people who are running electricity networks, big chemical plants, and so on. And these people recognize that it's inevitable in complex systems. There are going to be what some people have just called normal accidents. And what you have to try and ensure is that the system is actually robust to these kind of things. Now, what makes them robust is actually modularity, resilience, redundancy. Modularity means that you can separate one bit of the system from another. You try actively to reduce the interconnections. So if one part of the system fails, it doesn't produce a meltdown of everything. That's modularity. And redundancy means that things are duplicated. That's inefficient in the short run, but it means you're not dependent on any particular critical link. And if one or two things go wrong, and one or two things always will go wrong, there's actually alternative chains by which that can be coped with in the short term while you fix it in the longer term. That's the way you think about designing an engineering system. Now, when I describe it in these ways, you'll see the ways in which the finance system has actually tried to eliminate that kind of modularity and redundancy. Redundancy is regarded as a measure of inefficiency, and our structures have become more and more interconnected in the way you describe for Lehman Brothers. This is quite the wrong way of thinking about it. And if we adopt this kind of systems approach, saying what can we learn from other kinds of processes, I think we can do this a lot better.
Fascinating. We talked before that the primary metric for Goldman and J.P. Morgan, et cetera, is this return on equity. I want to get what you think the metric should be, and 8% capital is kind of what Basel and Dodd-Frank are shooting for. Where do you come down on level of capital?
Well, I think the level of capital is way, way inadequate. But the idea that I'm going to write a rule book that tells you how much capital J.P. Morgan needs seems to me fantasy. I would have to know much more about what J.P. Morgan were really doing, frankly, than J.P. Morgan itself does in order to be able to do that, which is why having an overall loose idea of the leverage involved is helpful. But remember, you said earlier that J.P. Morgan has gross derivative exposures of over $70 trillion. Now, that's simply an unimaginable number. It's actually more than the value of all the assets in the United States. And we don't know, and we externally can't know what the real risks involved in that size of portfolio is. So my solution to that is to say, well, let's try and create a world in which we don't have to know the answer to that, in which people can bank with JP Morgan and make sure their deposits are safe, but actually JP Morgan has to look after the scale of these exposures itself.
More on reforming Wall Street in our last segment, coming right up. And we're talking with Oxford and LSE Econ Professor John Kay. We're going to finish up our final national segment. You say that the short-term fixes of '08 that were needed are, of course, the absolute wrong long-term solutions. What are the right long-term solutions?
Right. Well, what we did in 2008 was we basically propped up the existing institutions, and there was no choice in 2008. Perfectly clear that Citigroup couldn't be allowed to fail in 2008. But actually, given that the problems lie in the way in which the structure of the industry has evolved, that ought to have been a preliminary to introducing the kind of structural reforms I've been talking about, separating out retail from investment banking, splitting the functions of the investment bank so that people were making their profits from how well they serve their ultimate customers and less profit from what they generated by trading with each other.
All right. A great linkage to making this happen is divorcing the influence of money coming in from politics, particularly from the financial services industry, lobbyists, etc. Do you have a fix for that?
I wish I had an easy fix to your problems of U.S. campaign funding, but you've got a lot of problems. Well, we've all got a lot of problems in our political system. You've got some pretty bad ones in the U.S. right now. It'd be kind of impertinent for me to tell you how to fix your political system as well as your finance system. But bluntly, so long as Wall Street has the political power and the ability to design regulatory structures or to influence regulatory structures to suit itself that it does have today, it's very difficult to see how we're going to get reform. And that's not just a problem for you in the United States, it's a problem for us and the rest of the world as well, because the United States is the largest driver in terms of the structure of global financial services around the world.
Do you believe that the tax treatment of debt, which allows interest deductibility and therefore favors equity, does that need to be repealed?
I think it's a problem, but it isn't, to my mind, the fundamental problem. And I wish I could find an easy fix to things there. I think we've another set of problems which actually we could spend another program talking about, which are what has gone wrong with the corporation tax systems of the world and how we might fix them. It's a lot easier actually to talk about what's gone wrong than it is about how we can fix them. The truth is, the reason banks reduced the amount of equity they had in their balance sheets was not so much that there was tax advantage to debt over equity, although there was. It was because if you were being judged by return on equity, it was an awful lot easier to reduce the amount of equity than to increase the return. And that's what a lot of banks did on a very large scale. The result was we ended up in 2008, and we still have today, banks managing with total equity to asset ratios, which they would not dream of lending to any non-financial institution if it had the kind of level of gearing and leverage that these institutions have.
When you call for change like this, culture change is normally the hardest thing to do. In some ways, you're calling for turning back the clock. Jamie Dimon would say that the fact that they put all these pieces together diversifies their risk. Do you think there's a realistic chance to go back to what you're suggesting? Do you consider it turning back the clock?
Well, we heard the argument that this diversification was reducing risk, and we learned in 2008 that it simply wasn't true. If I think back to when I was a schoolboy in Edinburgh, quite a long time ago now, the idea that the Royal Bank of Scotland would actually go bust was completely unbelievable, unthinkable. In 2008 it did, and the reason it did was that it had diversified into a wide range of activities that the people running it knew very little about. And the diversification can be a way of reducing risk, but the way it's happened in the financial sector has been that people keep diversifying until they get into a business they don't understand. I've sometimes called it a generalization of that Peter principle, that people get promoted to their level of incompetence. Now, can we put the clock back? Well, putting the clock back is a pejorative-sounding phrase. And the way I frame it is to say you want to put the clock back if it's not telling the right time. And in this case, it isn't telling the right time. And I think we just made a mistake by allowing the assembly of financial conglomerates that combined all these functions. It created conflicts of interest, it created conflicts of culture, and it allowed cross-subsidy from one group of activities to another. And we'd be better without all these things. Now, how do we actually achieve that, given the power of existing institutions on Wall Street that we've talked about earlier, is quite hard. But that's what we need to set as our goal. And I've said a few times with slightly rueful fashion that I think what I hope I'm doing is writing a manifesto for the politicians who have to deal with the next big financial crisis, because for sure there's going to be the next big financial crisis.
That's what I was actually going to ask you next. You think that another financial crash is inevitable, worse than now, or?
I think it's inevitable because the underlying mechanisms that have given rise to the financial crisis we've had in the past are still there. And if we think of the crises we've been through in the era of financialization, we started with a Japanese boom and bust in the late 80s, early 90s. Then we had the wider Asian and emerging market debt crisis in the 90s. We had the new economy bubble. We had the credit boom and bust 2003 through 2008. We in Europe have our ongoing, slow-burning Eurozone crisis, which we are very far from being able to fix. The basic mechanisms behind these are, I think, very much the same, and therefore, unless we embark on the kind of structural reform I've been talking about, I don't think we're going to move into a very different world.
This is really a seminal piece of work, I think. I want to thank John Kay. The book, again, is Other People's Money, the real business of finance. This has been Business Talk with Jim Campbell. Podcasts available at iTunes and biztalkradio.com and WYBC Yale Radio. Now, if you're listening on our flagship station, you can stay with us as we're going to go into overtime, and we're going to talk about a PricewaterhouseCoopers survey on the top global cities. But thanks to John Kay, thanks to our national audience for listening. We'll see you next Sunday on Business Talk with Jim Campbell.